Most traders never plan to destroy their accounts. It happens quietly, in a single session. In a session that begins like any other, a normal morning, a familiar routine, a belief that today will simply be another step forward. The charts load. The coffee is warm and nothing appears unusual. Yet, by the end of that day, weeks or even months of disciplined work can vanish. The experience begins, often with a subtle discomfort rather than panic. Perhaps the market moves faster than expected. Perhaps a position that normally behaves predictably begins to fluctuate erratically at first. The trader assumes it is temporary. After all, volatility is part of trading. The plan remains intact. The risk appears manageable. But as price continues to move against the position, something internal shifts. The loss is no longer theoretical. It becomes visible, measurable, and emotionally charged. What was once a calm analytical process starts to feel personal. The trader is not only managing risk, they are confronting uncertainty in real time. Most traders believe catastrophic losses come from recklessness. In reality, they often arise from attempts to regain control. The first decision that deviates from the plan rarely feels dramatic. It feels reasonable. Adjusting a stop slightly, holding longer than intended, adding to a position. To improve the average price, each action can be justified individually. This is the psychological trap. The trader is no longer executing a predefined strategy. They are reacting to discomfort. Losses create urgency. Urgency narrows perception. Instead of seeing the broader market structure, attention collapses onto the immediate problem: how to stop the loss from growing. The mind begins searching for reassurance, a technical level, a pattern, a reason the market should reverse. Sometimes it does. A small bounce occurs, reinforcing the belief that patience was correct. This moment is dangerous. It rewards deviation from discipline. The trader feels relief, even validation, but relief is not the same as resolution. If the market resumes moving against the position, the emotional intensity increases. What was once a manageable loss now feels unacceptable. Not only is money at risk, the trader's self-image as competent and disciplined is threatened. At this stage, behavior often accelerates. Position size may increase. In an attempt to recover faster, new trades may be opened without full confirmation. Risk limits that seemed non-negotiable earlier in the day begin to feel flexible. The trader tells themselves they are adapting, but in reality, they are compensating. Decision quality deteriorates gradually, not instantly. Fatigue begins to accumulate. Stress hormones elevate. Fine. Motor control changes. Mouse clicks become sharper, movements less deliberate. The trader monitors every tick, hoping for a reversal that will restore normality. This constant vigilance drains cognitive resources. Analytical thinking weakens while emotional impulses strengthen. The trader may recognize that their behavior is changing, yet feel unable to stop. Closing the position would lock in the loss. Holding it preserves hope. Hope becomes the final defense against accepting reality. When the loss eventually exceeds a threshold, financial or psychological, a collapse often occurs. Some traders exit impulsively, crystallizing the damage at the worst possible moment. Others freeze, unable to act, allowing the loss to grow further. Both responses stem from overload. Ironically, the market itself has not targeted the trader. It is simply moving according to broader forces. But in the isolated environment of a trading desk, the experience feels intensely personal. After the exit, a strange quiet follows. The adrenaline dissipates, replaced by disbelief. The account balance reflects the cumulative impact of decisions made over hours, not seconds. Months of careful progress can disappear into a single negative spike on the equity curve. Many traders immediately search for explanations: news events, market manipulation, unexpected volatility. While external factors may contribute, the deeper cause is usually internal: a breakdown in process. Under pressure, professional traders experience adverse days as well. The difference lies in structural protection. Risk is defined before the session begins, not adjusted during it. Maximum loss limits are treated as absolute boundaries. Once reached, trading stops, not because the market is closed, but because decision quality cannot be trusted under heightened emotion. Professionals also understand that recovery attempts on the same day are particularly dangerous. After a significant loss, the mind seeks redemption. This creates a bias toward action, even when conditions are unfavorable. Stepping away preserves capital and mental clarity. Another critical distinction is expectation management. Amateurs often assume that consistency means steady upward progress. Professionals assume that large drawdowns are possible and design systems to survive them. Survival, not perfection, is the primary objective. Identity separation is equally important. A losing day does not imply incompetence, it reflects variance. Within a probabilistic activity, when identity is tied to performance, losses become threats to self-worth. The deepest damage from a catastrophic day is not financial, it is psychological. Confidence fractures. Future decisions become colored by fear of repetition. The trader may hesitate on valid setups or overreact to minor losses, creating a cycle of instability. Recovery begins with acknowledging the event was not random misfortune but a predictable outcome of unmanaged pressure. Rebuilding requires reducing position size to levels where losses no longer trigger intense reactions. It may feel slow, even frustrating, but stability must precede growth. Equally important is redefining success. Instead of measuring progress by profit alone, measure adherence to process. A day in which rules were followed precisely, even with a small loss, is a success in professional terms. This shift restores a sense of control that is independent of market outcomes. Structured routines also help restore equilibrium. Scheduled breaks, predefined trading windows, and clear end-of-day procedures prevent trading from becoming an endless reactive loop. Discipline becomes externalized rather than dependent on willpower alone. Over time, traders who recover develop a quieter relationship with risk. They no longer seek dramatic gains. They focus on consistency, knowing that compounding small advantages produces meaningful results without exposing the account to catastrophic events. Many experienced traders eventually realize that the most dangerous moments are not when they feel afraid, but when they feel compelled to fix something immediately. Urgency is often the precursor to error. The paradox of trading is that restraint frequently produces better outcomes than effort. Doing less can protect more. Waiting can outperform reacting. Accepting a manageable loss can prevent an unmanageable one. Long-term profitability depends less on predicting markets and more on regulating behavior under stress. Technical knowledge may determine entry points, but emotional stability determines survival. If you have ever experienced a day where months of progress seem to vanish, it does not necessarily mean you lack skill or discipline. It means you encountered a situation where pressure exceeded your current coping structures. The solution is not to trade harder, but to build systems that prevent such pressure from accumulating again. Consistency in trading is built on durability. The goal is not to avoid losses entirely, that is impossible, but to ensure that no single day can threaten long-term survival. When traders internalize this principle, their relationship with the market changes. They stop trying to win every battle and start managing the campaign. Individual outcomes matter less than the integrity of the process. Over time, confidence returns, not as excitement but as steadiness. The trader trusts their rules, their limits, and their ability to step away when necessary. This quiet confidence is far more resilient than the intense optimism often present at the beginning of a trading journey. Ultimately, the difference between those who recover and those who do not is not intelligence or technical skill. It is the willingness to prioritize protection over pride, structure over impulse, and long-term survival over short-term redemption. If this perspective helped you better understand how a single day can undo months of progress and how to prevent it, consider subscribing to Mindful Trader Lab for structured guidance on trading psychology, emotional discipline, and professional mindset development. You can also support the channel by liking this video and sharing it with other traders who may be struggling to maintain consistency under pressure. Thank you for watching and for investing your time in becoming a more disciplined, resilient, and self-aware trader. Stay mindful of your process and remember that survival is your primary objective. Until next time.